Coming up is our inaugural panel discussion of the day on growing global allocation to Indian alternatives. The landscape of Indian alternative investment funds has witnessed a notable surge in investments from global institutions, reflecting the growing attractiveness of the country's diverse and expanding opportunities. Global institutional investors are increasingly drawn to India's alternative investment space, encompassing private equity, venture capital, real estate, and infrastructure funds. As global institutions seek to diversify their portfolios and capitalize on India's economic potential, they are actively participating in and sometimes forming partnerships with Indian alternative investment funds, driving increased capital inflows into the country's dynamic and evolving investment landscape. To dwell deeper to this, let me call upon on stage our panelists. Mr. Harish Agarwal, President and COO, Edelweiss Alternatives. Give it a huge round of applause for all our panelists, guys. Come on. Thank you. Mr. Prashant Mohanraj, Senior Partner, Alpha Alternatives. Mr. Rajesh Gandhi, Partner, Deloitte, Haskins and Sells. Mr. Norbert Fernandes, Director, TR Capital. Mr. Neelesh Surana, Chief Investment Officer, Mirae Asset Investment Managers.
Okay, all right, everyone. Good morning, and sorry for this slight technical delay. So welcome all of you. Welcome our panelists. Thank you, Neelesh bhai, Prashant, Harish, Norbert. I think the fact that AIFs have come of age is proven by the fact that you have foreign investments coming in directly into AIFs, and it is considered as a chosen model or way of investing. And no better proof of that today we are starting our discussion with foreign investment or offshore investments into AIFs. Ajay bhai has given some statistics for you all. Maybe I'll throw in a little bit more numbers just to showcase to you how foreign investments are slowly growing in the AIF sector. And Ajay bhai rightly said, large part of the investments is in Cat 2, private equity investments, about 70–80%. We don't have official numbers of foreign investment into AIF, not reportable, but as per unpublished numbers, it's about 7 billion of investment and growing at 55–60% per year. Again, a large part comes as private equity investments. Most of the investments have come from two countries, no guesses, Mauritius and Singapore. There may be masked way of investments coming from US and Europe, especially coming from Mauritius, about 50–55% investments. And I think one good thing about the AIF industry is that from an investor point of view, a foreign investor point of view, it is very light in the sense that, of course, you need to get your tax ID, PAN, and file a return generally. But otherwise, for example, if you are an Indian manager managing a Cat 2 fund, then even if you have a foreign investment, as you know, it is considered as a rupee investment. So all the guidelines around ECB regulations, etc., they don't apply for any debt investment through AIF. Or, for example, if it's a Cat 3, then the key condition is that an AIF can only invest in those securities where a FPI can invest. But other restrictions like cap on investments, etc., they don't apply. And as you know, virtually today, FPIs can invest almost in all securities except maybe short-term money market mutual funds, etc. So in that sense, the regulations are very light to attract foreign investments. In fact, GIFT City, as you know, has gone one step further to say that no PAN, no tax return, etc. You can just invest freely. You don't have to be bothered about registering in India. You are treated just like you invest in an offshore fund. But that's not the focus of a discussion. As a professional, we're always tempted to talk about regulations, tax. That's not the focus of what we are speaking today. We have these four gentlemen, and I think it's a wide variety. They specialize. Each of them are well-known in their respective fields. They specialize in different products. So maybe, Neelesh, I'll start with you first. And before we go to specific products, maybe an overall, and for all four of you, is in terms of how do you see the India growth story if you compare with China or maybe other jurisdictions, and more particularly on foreign investment, and if you want to speak about AIF growth as well.
Sure, yeah. Thanks for the invitation and introduction. Well, I think India growth story, I think all pieces are coming together. All of us in the room obviously would be very positive. I mean, I would say literally even a Panwala knows that we'll reach 5 trillion and beyond that. Such is the sort of construct now. Let me give a bit of backdrop that why wealth creation would happen. And when we talk of AIF and foreign money, I think it's more relative. And the right comparison obviously will be China. So I think if you look at the core principle or trinity of wealth creation, it's growth, the quality of growth as quantified by return on equity or return on capital employed, and the longevity of growth. So if I were to just very quickly summarize what happened in last, say, 3 decades, in last 30 years, China had very high growth, US dollar nominal GDP growth of 13.8%. The wealth creation is less than 1.8% CAGR. I mean, they have not done anything. In fact, Nifty and China index, we touched the lows in global crisis at 3,000. They are still at that level. In last decade is lost, last 2 years is minus 49, 50%. US is, there is a premium because they, obviously the growth is 3.8% dollar growth, and the markets did well, 8-9%. And that's because ROEs are much superior because of technology. India last 30 years about 8.5% dollar growth, nominal GDP, and market growth is similar. And real GDP growth for us in rupee terms is 6.5. What I was saying is, if you look from a longer term perspective, clearly on real GDP growth and nominal growth, we have very strong pillars of growth. I probably will touch in subsequent sort of session. That if we grew 6.5% for the last 2 decades, there is no reason to believe that the real growth will be 6.5, probably 7%. And nominal growth, we are talking 11, 12%, very powerful number. Second thing is the differential in interest rates, inflation has come down, so currency depreciation, all else being same, would be less. So we are talking of very high longevity and absolute number of growth, and most important thing is our ROEs are improving. For the first time last year, we surpassed US. So I think all the construct is there, that the wealth which has been created over the last 2-3 decades, at least that and more should happen over the thing. And as you mentioned about China and all, similarly, as I mentioned, they have literally lost decade because they focused on scale, not on quality of the character of the growth or so. And that's reflected in the construct of the, let's say, if you look at benchmark of MSCI emerging markets, we were 1/4 of China 10 years back. They were at 20%, 23, 24%, we were 6%. Today we are 17% of that benchmark, and they are at 22%. So I think this will only increase, and to that extent, as a top-down story, clearly, I mean, very less option, even near-term, once the interest rate and end of low interest rate regime or regime change in interest rate, we come to more normalized rate, people will hunt for growth, and that's where India would continue to attract a very significant amount of money. It could be lumpy, but it will happen.
Wonderful. Prashant, you want to share thoughts, particularly on the AIF growth as well, along with what Neelesh mentioned?
So thanks, everyone, and thanks for the opportunity. First of all, I'd also like to say hi to all the panelists, and especially Norbert. We were neighbors for a long time, and it's good to catch up. It's a pleasant surprise to see you on the panel. Yeah. So like Neelesh was saying, I think one of the things for any global allocator today is that you can't ignore India. And in many ways, for any global allocator today, of course, US is the mother market, but most other markets, whether it's Europe, whether it's China, whether it's South America, those are very difficult markets and very challenging markets. And India is obviously, one of the markets as a global allocator is probably one of the most promising markets. And we are blessed to be at a time where we have seen 2 decades of stupendous growth, but the future looks even better. What's also interesting, probably from an alternatives point of view, and for any allocator investing into alternatives, not just India alternatives, even if I take a step back, what is an allocator looking for? A couple of things. One is very strong, attractive risk-adjusted returns. And the second is diversification in terms of uncorrelated returns to its traditional equities and bond portfolio. So those are two very important things that an allocator looks at. And there again, I think India, of course, you have the long-only growth story that is there on the equity side and also on the fixed income side. But what is very exciting on the alternative side is, and here again, I would cut it into two parts. You have the hedge fund kind of categories, which is the Cat 3 AIFs, where, amazingly, for a lot of people outside India, they don't realize what a strong capital market we have here. We are actually the most liquid market globally on the derivative side, largest number of contracts traded. Any parameters that you look at, we'd be in the top 2 or 3 as such. So this is something in many ways, we are no longer an emerging market. It is a very, very liquid market, and that gives a whole lot of opportunities as far as hedge fund strategies are concerned. And similarly, what I would call the illiquid alt side, which is things like credit, private equity, real estate. Those traditional sources of financing are a lot more challenging in the Indian markets, and that's where the real estate funds, the credit funds, the private equity funds have a great role to play, and they have been doing that as such, and we are seeing amazing opportunities out there. So both in terms of the liquid as well as the illiquid, there are tremendous opportunities on the alternative side. What is important is, as fund managers, we stay true to our mandate. Risk-adjusted returns is something which we talk about a lot, but is very, very important for an alternatives allocator, because if you're getting the same kind of market volatility that you would in investing in a long-only equity fund, then why would you be in alternatives? And that's where risk management becomes very critical, because for an allocator, what risk management allows it to do is gives it much better predictability of outcomes in terms of what the returns are going to be, whether the markets are volatile, non-volatile, up, down, whatever else as such. So it's important for us to be true to our mandate as such. So.
Perfect, thank you. Maybe Harish will get a little bit more specific in terms of, we discussed earlier also, AIFs have generally meant private equity investments, but private credit has also grown over the last few years. But what do you think is the future, especially if you look at US yield versus India yield, the difference reducing. So can you lay down a crystal ball? What do you think how does it look like?
So, alternative industry have gone through a tremendous change. If 2005, private debt or private credit, as we say, was only 2% of the total alternatives. Today, between infra and private credit, it's actually 27%. So from putting number in context, from 1.1 billion, it has become 25 billion. What is the advantage of a private credit or an infra? Here you have cash flows, collateral, and also a portfolio diversification. Just to put you context in the foreign money, in fact, we ourselves have 4 billion of foreign money. So I think the number which you have mentioned of 7 billion will go significant change. So as a foreign investor, they are looking at India as the one market, because the very large allocation used to go to China. Now, due to geopolitics, those investments are not happening, because we keep on traveling to US almost 4-5 times a year. So we are a very major fundraiser there. So from a geopolitical perspective, India is in a good place. Second, I buy your point that there is a yield difference that has shrunk tremendously between US and India. But still, from a diversification perspective, India is a very important market. People have learned it the hard way that if you only check on the efficiency and not the resilience, what can happen in case of a large geopolitical event. So this number is hugely growing every day. Like many of these global players, pension fund, insurance companies, they have long-term capital, which they want to put in alternatives and long-term money. Traditionally, they used to come from fund managers, and now you can read in the newspapers, some of the big ones are coming directly. So I feel the India credit or India alternatives is a huge opportunity to grow. To put some more data in the context, see, we are 4% of global GDP, but we are less than 1% of global alternatives. So the huge, whichever parameter you look at, what is required is a a good governance framework, which SEBI is doing a lot of work on, so that the accidents are minimized and the trust in a nascent industry, I still call it nascent because we have a long way to grow, is maintained.
Interesting. Now, but not just from a yield perspective, but overall, how do you see foreign investment coming in the PE space, VC stroke PE space?
Sure. So, I think first, Neelesh bhai has very nicely covered what are the fundamental reasons why India is attractive, and maybe there's a confluence of factors right now which wasn't there earlier. So it genuinely is, just from a bottoms-up perspective, far more interesting now for a global allocator. So TR Capital is a Hong Kong-based fund. So because of that, we have a slightly interesting vantage point in that we end up interacting with a lot of LPs who are also very China-heavy. So maybe I can share a little bit about how those set of LPs are thinking about India. So there are multiple factors which go into decision-making of allocation to India. And I'm speaking, like you said, more or less from a PE, VC, secondaries point of view. The first factor probably, I'd say, is we are coming off a fairly aggressive valuation environment. And you're increasingly hearing about XYZ company raising a down round and all that, right? Because it's an artifact of the fact that there's a lot of cheap liquidity, access to capital was quite easy, and that's part of the cycle, that's normal. But that is leading to a little bit of hesitation now in deploying capital, lengthened timelines to close deals, all that. So there is a bit of slowness in the PE/VC side right now. Second factor probably is it's the corollary of cheap liquidity ending is that the interest rates have risen in the US and in developed markets. So there's an overall giant sound of suck of liquidity going back to the developed economy. So that affects allocations to all emerging markets because that's the first place from where capital gets pulled back. Thirdly is a very direct India versus China comparison that gets made all day long. And to me, we interact with so many LPs, and the extent to which people are shying away from China right now, it even surprises me at times. So definitely, India has become far more interesting within the emerging markets bucket when they think of allocations. And if I were to put a fourth factor into all this decision-making process, it's really the national elections in India. A lot of people were probably waiting on the sidelines and wanting to see how that plays out, but with the early indications from the state elections, a lot of those decision-making and a lot of those plans have advanced maybe 6 months, and people have gotten more interested in deploying a little bit earlier than they would have earlier thought of. But broadly speaking, in the PVC space, if I were to sum it up, my view is interest level is very high. However, deal making is a bit slow. And there's a lot of dry powder sitting. So before making additional allocations, allocators are asking, do you really need additional allocations? Because there's already so much dry powder. For us, it's actually a good environment because we're secondaries, right? So a lot of funds are looking for ways to generate liquidity, and secondaries is one way to do that, so that they're able to return capital to their LPs, and asking LPs to allocate to their next fund when they have returned capital becomes a far easier decision than asking them to make an additional allocation. So these are some factors which, at least in our corner of the alternatives world, what we see playing out in the allocators' heads.
You mentioned about secondaries. I mean, how do you see the secondaries play? Because globally, it's a big play in India.
Yep.
How do you see the play in India versus global?
Absolutely right. It's a globally well-established model for delivering liquidity to investors in the private equity and VC space, because the traditional routes of IPO, M&A, acquisitions, etc. They are very meaningfully large, but they are not the only ways to deliver liquidity. And in Asia, I would say it's a little bit of a developing asset class, secondaries, and a bit of a niche. And there are just a handful of people who kind of play in that space. What I believe is that in the next 10 years, like you all mentioned, right, with the increasing penetration of equities as an investment asset class, within that alternatives will also grow probably super normally. Within that secondaries, I think will be also one of those categories which will grow super normally within the alternative space, just because, and this is part of the cycle of evolution of a market. India so far has raised and deployed a lot of PE/VC money, but the returns, and I'm talking about cash-on-cash returns, not NAVs, there's a big gap. India has not delivered as much returns as you would have expected as an LP so far in this category. And a big reason is that there need to be more alternative ways to generate liquidity. So secondaries falls squarely into that. And I think there's a tremendous opportunity in India. I mean, whichever way you cut the data, there's at least 50 to 100 billion worth of unexited positions in funds which are sort of heading towards their end of life period. So that's the opportunity set for us. It's there.
Okay. And what you mentioned, I think, takes me to my next question. And maybe in the interest of time, maybe a bit more short answers is, what do you think is, Harish bhai, is the expectation of foreign investors, when they look at, maybe for example, your products, etc., investing into India?
See, one of the things which they want is an institutional platform, because from a longevity is very, very important for them. Many of the star fund managers, they go and start a shop. Normally, a big pension fund or a big insurance company would be careful and very mindful, because for them, key man risk is very important. In an institutional platform, that get mitigated to a large extent. Hence, you will see over last 20 years, the bigs of the world like BlackRock, Blackstone have become bigger and bigger. Number two, I would say, is asset management capability. Like all of us spoke that what we get premium is for the illiquidity versus the public market. So asset management become extremely important. Third would be the stability of the team. So I would say institutional platform, asset management, and stability of the team. If these three are there, others like your vintage and track record follows.
Prashant, you want to share thoughts on the same thing? Neelesh, you also.
Actually, it's very similar to what I was talking about earlier in terms of, I'd go back to exactly what I said, that what a global allocator is looking for in terms of alternatives is, strong risk-adjusted returns and diversification in terms of being uncorrelated to your traditional bonds and equities. And the third thing is to be true to your mandate. And this is something which is, again, very important from an alternatives point of view. That is something which anybody who is investing into alternatives, if you look at, a lot of what has come into the liquid alternative space in India, the hedge fund space in India as such. We have seen this in the past, and these are things which are very difficult to get back from as well. Is in 2008, you saw a lot of India hedge funds which were down 50, 60%. And then those are not hedge funds. Those are, long biased or beta masked, hedge funds as such. And that's where the evolution has really happened, both in terms of the liquid alts as well as the illiquid alts, where today, with a vibrant derivatives market, there are a lot of strategies, a lot of, very, very good risk-adjusted returns available as such. We've been running this for the last 7 years. We've been doing this for 20 years across prop desks, but as a hedge fund, we've been running for the last 7 years, and we have generated a 23% CAGR. But what's more important is, this is with no negative quarters. And you've got to stay true to your mandate in terms of, not being swayed by the market going up and taking beta risk when you're not supposed to take beta risk as such, and being very, very risk controlled. Same thing on the illiquid side. The fact is that over the last 10 years, we've seen a lot of evolution and a lot of sophistication that has happened on credit, on real estate, on private equity, on VC. And I think, those opportunities are very much there. And for any allocator today, like we said, that India is too good an opportunity and too big an opportunity to miss. A lot of the fundamentals are well in place. I joke about the fact that if you look at, if you didn't tell anybody that this was the Indian market versus the US market, if you look at the macro over the last couple of years, India has looked like a developed market and the US has looked like an emerging market. it's been, we've got very strong, macroeconomics, we've got very strong regulations, we've got a very stable environment, and we've got to take advantage of that.
Right, absolutely. Neelesh bhai, you have the benefit of also having an outside-in view because of your global funds. You see, as Korea headquartered investors, obviously investing in multiple countries, also looking at India, mutual fund, AIF. So same question to you. I mean, what is the investor expectation when they choose India versus other countries?
No, so other panelists, even Harish sort of covered. I think it comes back to the same sort of repetition in terms of confidence on the longevity of the growth. And what happened, at least in last decade, country-specific funds lost a bit of charm. It was all commingled as a regional fund and so. And there the experience, particularly what Harish touched and Norbert touched, is particularly on China, has a lot of rub-off. I mean, not only on the PE side and all, where they overnight that tech $150 billion got wiped out or something like that. There is a reason why that market is trading at 9 PE multiples or so, despite whatever 4+% growth. So I think it's frankly a bit of Tina factor in that sense, that longevity of growth. As people sort of, so that probably the number of products available are less compared to the appetite over time which would happen on country-specific fund. And ultimately it will come to the basics of the pillars why this country should grow at a particular level, which on a relative basis there is no other economy of our size, of this size, of 3 trillion plus, where you can get confidence not on the outcome of growth of 6.5% or doubling the economy in 6-7 years if you look at nominal growth, but on the pillars that why it should grow, demographic, infrastructure, now manufacturing, reforms, all that.
In fact, we have a problem of plenty today. They were used to doing $1 billion deal. In India, even 100 million, 200 million get reported on the first page of the newspaper. So our as an economy's ability to go into that capex cycle and to absorb that kind of money, I don't think it's lack of money, but our ability to absorb money would be very important.
No discussion on funds is complete without the gift city. So my last question, all of you, it's not just banks and AIFs, right? It's also the Filmfare Awards which are happening in the gift city this year. So it's become really quite vibrant in some sense. You have recently launched or about to launch your gift city fund. So how do you view gift? I mean, do you think that's a shift of money from domestic to gift? Is it incremental money? I mean, what's your view on gift?
It's a totally different set of audience, and my colleagues are, I mean, we are in the process of launching a fund, category 3 AIF. We have set up the infrastructure, and in Gift City, I mean, it's slightly difficult to get a bit of talent on, at least on the investment manager side, but all that has been sort of done. And the entire ecosystem, what we can see, the regulatory part, particularly coming from the top, is working focused with a very focused approach to make it a success. The taxation rules are very congenial both for investors, even for manufacturers. I mean, no GST, no income, there is a tax 10-year window, etc. So there's a massive thrust to compete with Dubai, Singapore, and all that. It should succeed. As I said, the number of funds may be 50, offerings may be 100, but it's just started, not even started. So we will be launching a fund which will feed into our existing fund, which has in turn 10-15 years track record. So those models will happen, but I think we will not even scratch the surface. So a lot more to come because of tax efficiency, as I said, because when they look at it, and the concept of SIP and all, probably equivalent of that could also come, that if here is a country where you get very stable long-term growth, and you can have in a more tax efficient manner invest. So particularly for inbound sort of money, I think it's more about technical execution part and attracting and launching the products. Yeah.
Prashant, your thoughts? I mean, especially derivative side, complete tax exemption if you invest through a gift city fund. So your thoughts?
Yeah. So and I'll focus a lot more on the hedge fund side of the world because our panelists here cover the private equity credit space very well. And actually, for a Cat 1, Cat 2 investor, for a global allocator, investing directly into the Cat 2 funds and Cat 1 funds are quite easy because these are pass-through vehicles. Cat 3 is very different, and unfortunately, Cat 3 AIFs have become very, are not very tax-efficient vehicles either for domestic investors after the change in taxation where most trusts are now taxed at the highest rate, nor is it for global investors because effectively it gets taxed at the fund as compared to if they come directly as an FPI. Derivatives are not taxed at all, and there's a big tax differential between investing directly as an FPI as compared to investing through Cat3. So the ease of investing into Indian hedge funds is just not there, and that is where GIFT City is a big leap forward, because otherwise it was about setting up a base in Mauritius or Singapore or elsewhere as such, which in many ways is not, if you look at it from an asset management business point of view, it's not a very long-term viable structure, because you know that 20 years down the line, you are not going to be able to sustain a very clean, kosher jurisdiction coming out of these places. And this is where GIFT City is very useful. We in fact started our fund. We were probably one of the first funds who started, because we were very happy when GIFT City came about and the regulations were cleaned up, and to that extent, it is very encouraging. It is a very, very favorable jurisdiction, both from a tax point of view, from an ease of investment point of view as such. So we started about 1.5 years ago. And for any allocator looking to invest into hedge funds, unlike, let's say, Cat 1 and Cat 2, where they can come in directly, I think GIFT City is a huge boon. The one thing that we can wish for and hope for is that the regulations remain consistent. And I think anybody who's setting up a business, whether it's in the asset management business or any industry, what you need is consistency in policy as such. And that is where we've not had that on the Cat 3 domestically, with the tax changes and the regulation changes. We hope, as far as GIFT City is concerned, that all of us can try and make sure and can try and lobby and just ask for consistency in policy. We're not asking for anything favorable as compared to any other jurisdiction as such, but just a consistency in policy is very important.
The IFSCA will be relieved to know that you're not asking for more concession, you're just asking for what you're given, just keep it where it is.
Exactly, because then you know what the rules of the game are. The rules of the game keep changing, then it's very difficult to build a business around that.
You all want to thoughts? Any thoughts on GIFT City?
We are obviously a foreign investor, so that route becomes immediately interesting for us. And while we haven't made the switch yet, be candid, we are evaluating it closely. See, the sheen of Mauritius and Singapore have largely gone away now with the removal of the double tax avoidance treaties and all that. So it comes down to cost, it comes down to ease of execution. And from what we understand, GIFT City is making a lot of strides on all those points. So at some point, it becomes very natural to shift. We have not reached there yet. Also, it's a question of the life cycle of the fund, etc. So maybe in our next fund, we will seriously consider coming through GIFT City. We recognize the advantages. I mean, it's especially very close to Bombay. So just, operating it becomes super easy.
Our experience has been very good. The regulator have been super responsive. So we have had multiple discussions, and budget has done a lot of clarity, at least I'm talking from the debt side. In fact, we have transitioned $2 billion of fund. So currently we must be among few of the top funds over there. So regulator has been extremely responsive. Like my experience with MAS in Singapore has been, you send an email and you get a response. Something similar happened at GIFT City. So at least we are very, very pleased. And I think, as all the panelists are saying, GIFT City has to be the way forward, because Mauritius and Singapore, as the size and scale we are growing, will become unsustainable at some point of time. Yeah. The only thing is that this regulatory part, the confidence of the foreign investor has to be higher. So currently, for us, we actually pool in Singapore, and then through GIFT City it comes in. But direct pooling of GIFT City should happen over a period of time. That will make it much more interesting. But all the big insurance and pension fund has to be convinced on that. Currently, their comfort on the treaty coverage or the treaty protection is much higher. I think that's the journey we have to cover.
Right. I think one announcement which will kickstart further is the 100% NRI OCI investment, which we are hoping will come through GIFT. But I think very valid points. Some of my other clients also say that when we are in GIFT, we are very close to the regulator physically as well. So it's very easy to solve queries, etc. But yes, large pension funds, sovereigns are still a bit skeptical, and they prefer the standard Delaware for US or Cayman structure, depending on whether you are US taxable, US exempt. or even Luxembourg if you can afford. Some of my clients I've seen are more and more looking at either Dubai or even Ireland, ICAPs, to a large extent compared to Luxembourg. We're still not there because being a very costly jurisdiction, Indian managers do prefer Singapore, Ireland as compared to Luxembourg. But yes, I think that's very interesting. Aditya, I don't know if you have time for questions, but sirs, gentlemen, thank you so much for your insights. I'm sure the audience found it very useful.
Thank you.
Thank you. Thanks, Rajesh.
Thank you.
Thank you so much. I request all the panelists to please stay back on stage. And now may I please call upon Mr. Aditya Gadge, founder, Equalify and Prevexis, to please felicitate all the panelists. Can we have a huge round of applause, please? Thank you.